So you've probably heard it 1,000 times. You have to do a Roth IRA conversion. It's the default advice from nearly every financial guru out there. And yeah, I know, we've even done one on the benefits. Check out our video on the step-by-step Roth IRA conversions. But what if I told you that for many high earners, especially those approaching retirement, it can actually be terrible advice? What if the very move that's supposed to guarantee your tax-free retirement ends up costing you more in overall taxes instead? Now, I've always said to clients, although Roth IRAs can save some people a fortune in taxes, for others, it just doesn't make mathematical sense. The numbers don't work, and for those people, the taxes they'll pay by converting from a traditional IRA to a Roth IRA or doing a large backdoor conversion will never be made up by the tax-free structure of the Roth. So today, we're going to skip the sunny side of Roth conversions. We're going to expose the hidden tax traps, the practical blunders, and the irreversible regrets that can turn this popular strategy into a financial nightmare. Now, I know that's a lot, but at least a bad decision. If you're a high earner or a business owner, you're going to want to stick around because this is the video that gurus never really seem to make. So before we get started, my name is Steve Borstein. I'm a financial planner, and this video is for educational purposes only and does not constitute individual investment, tax, or legal advice. So always consult with your financial and tax professionals before making decisions. And if your advisor isn't talking to you about this, contact us. This is what we do all the time. We'd be more than happy to sit down and see if we can help. All right, so let's get straight to the biggest and possibly most overlooked danger, the immediate tax consequences that go way beyond your normal income tax bracket. When you do a Roth conversion, your money's moving from a pre-tax account, like a traditional IRA or 401k, over into a post-tax Roth. The price you pay for that future tax-free growth is paying income tax today on the entire amount converted. But here's the problem. That conversion amount gets tacked right into your modified adjusted gross income, or MAGI, for the year. For high earners, a sudden spike in MAGI is an invitation for triggering a whole series of stealth taxes courtesy of the IRS. The first and most painful one for anyone nearing retirement is called IRMAA, or Income-Related Monthly Adjustment Amount. This is a surcharge you get slapped with on Medicare Parts B and D if your income pops over a certain level. And here's the critical part. The Social Security Administration has a 2-year look back. So the income they use to calculate your 2025 IRMAA today comes from your 2023 tax return. Imagine you're 63 and you decide to do a big Roth conversion. You might be retired thinking, hey, I'm in a low income year, but that conversion balloons your MAGI, and 2 years later at age 65, when you're on Medicare, you get a nasty surprise in the form of a letter that tells you your premiums will be hundreds or even thousands of dollars higher for the entire year. For 2025, the IRMAA surcharge kicks in for individuals with the 2023 MAGI of over $106,000 or a married couple with a MAGI of over $212,000. Medicare uses a 2-year look back, and the thresholds adjust each year for inflation. A hefty conversion can easily shove you over one of these cliffs. And since they're brackets, going over by just one single dollar can be a very costly mistake that reduces the overall effectiveness of your Roth conversion. But IRMAA isn't the only hidden tax. There's also the net investment income tax, or NIT. This is a 3.8% tax on investment income for individuals with a MAGI of over $200,000 or $250,000 for joint filers. While the conversion itself isn't subject to NIT, by inflating your MAGI, you can push your other investment income, like capital gains and dividends, over the threshold, triggering the extra 3.8% tax. Note, NIT applies only to net investment income, capital gains, dividends, interest, etc., and is assessed on the lesser of that or the amount of your MAGI exceeding the threshold. Again, this can quickly turn a conversion that looked like a smart move into one that you maybe wouldn't have done if you had realized the extra tax impact. The next huge mistake some people make is converting at the absolute worst time, during their peak earning years. The whole premise of a Roth conversion is a simple bet. You're betting that the tax rate you pay on the conversion today will be lower than the tax rate you'd pay on that money and its growth in retirement. So if you're a 58-year-old business owner coming off a fantastic year or a high-level executive who just got a massive bonus, your marginal tax rate that year is likely to be one of your highest. Converting in that environment is like intentionally running into a tax buzzsaw. You're prepaying taxes at the highest possible rate, which completely misses the entire point of the strategy. The smarter play is to wait until the gap years, those years after retirement, but before you start taking Social Security and required minimum distributions, and maybe even your pension. During this window, your taxable income is often at its lowest point in your adult life. This is the conversion sweet spot. In fact, instead of one massive tax exploding conversion in a high income year, a far better strategy is often to do a series of smaller strategic conversions during these low income gap years. You can do what they call filling up the lower tax bracket each year, just converting enough to stay in the lower tax brackets, stay below the thresholds, and not trigger those stealth taxes like IRMAA and NIT. It takes more patience and planning, but it could save you thousands or tens of thousands of dollars short term and possibly tens to hundreds of thousands of dollars over the long term. The next point is just simple math, but it often gets ignored in the excitement over tax-free growth. When you do a Roth conversion, you're hit with a significant tax bill up front. That money's gone forever. It's no longer in any of your accounts to grow and compound. For a conversion to be worth it, you need enough time for the tax-free growth in the Roth IRA that you're converting to overcome that initial tax hit. It needs to catch up to what you would have had if you had just left the money alone. So if you're 70 years old and you're thinking about a large conversion, you have to ask yourself, how many years will it take for this strategy to break even and start to pay off? Your time horizon is much shorter, for example, than a 40-year-old's. Financial models often show that your total net worth actually drops right after a conversion, precisely because of the upfront taxes that you paid. So for example, if you're over 70 years old and you're thinking about a large conversion, you have to ask yourself, how many years will it take for this strategy to break even and start to pay off? Your time horizon is much shorter, for example, than a 35-year-old. Financial models, when we model it out, often show that your total net worth actually drops right after the conversion, precisely because of the upfront taxes that you paid. It can take years, sometimes even decades or more to break even. For many people over 65, the math just doesn't work. The upfront tax cost is a guaranteed loss, while the future benefit of the tax-free growth isn't guaranteed to have enough time for you to make up for it. You need a long enough runway for your investment to take off. If you're already quickly approaching your longevity destination, a conversion might be dead weight, excuse the pun. Now, with lifespans increasing and people living longer into their 90s, I'm not saying it's definitely not worth it. It just becomes more important consideration. Now, if your reasons also include things like legacy and estate planning, then in some cases, it may not matter much at all. But your expected longevity, as well as how long you can wait before tapping the converted funds, is very important, and that consideration is even more important the older that you get. So this next one is potentially one of the worst mistakes you can possibly make. When you do a Roth conversion, taxes will be due. The worst way to pay that tax bill is by using the money from the IRA itself. And here's why it doesn't work. First, if you're under 59 and a half, the money you withhold from the conversion to pay the taxes is often treated as an early distribution. That could mean you get hit with a 10% penalty on top of the income tax. Second, and far more importantly, you're gutting the very fortress you're creating for your tax-free wealth plan. Every single dollar you use to pay the tax bill is a dollar that's no longer invested in compounding tax-free in your Roth IRA. Let's say you convert $100,000 and you're in the 24% tax bracket. If you withhold $24,000 to pay the tax, you've only moved $76,000 into your Roth. You've crippled nearly a quarter of your conversion's potential from day one. The only time a Roth conversion usually really makes sense to me is if you have enough cash in a separate non-retirement account, like a savings account or brokerage account, to pay the entire tax bill. If you don't have the cash on hand, you should really seriously reconsider at least shrink the size of the conversion to an amount that you can truly afford with those outside funds. All right, for those of you who are already old enough to take required minimum distributions or RMDs, there's a very specific rule you can't break. The RMD age is currently 73 for most people. Now, under current tax law, the Secure Act 2.0 sets the RMD age at 73 if you turn 73 between 2023 and 2032, and then 75 for those reaching 74 in 2033 or later. Always check the current law before acting. So if you're required to take an RMD in a given year, you must take that RMD before you can convert money from that IRA to a Roth. The RMD amount itself can never be converted. It has to come out of the IRA and be counted as taxable income. Only after your RMD is satisfied can you convert any remaining balance. Getting this wrong can lead to steep penalties. The penalty for failing to take an RMD is 25% of the amount you should have withdrawn. It can be reduced to 10% in some circumstances, but you don't want to get into that situation. This is a simple mistake, but the penalties can be significant. So always take your RMD first. This brings us to a critical update that permanently changed the game for Roth conversions. So before 2018, you had an escape hatch. If you did a conversion and then the market tanked, or a surprise bonus pushed you into a higher tax bracket, you could recharacterize it. Basically, undo the conversion and take the money back and put it into your IRA like it never happened. This escape hatch is now gone. The current tax law makes Roth conversions irreversible. Once you pull the trigger, you're stuck with the tax bill. You can't recharacterize it. This makes planning that much more important. You can't afford to be sloppy. If you do a conversion early in the year, which increases your income, and then get hit with a surprise capital gain from a mutual fund in December, or a bonus payout, or anything else that increases your modified adjusted gross income, you can't undo it. This is why it's often much safer to wait until later in the year to do a conversion, when you have a clearer picture of your total income for the year. So hopefully you're starting to realize how important proper planning is for this strategy to work. Look, navigating these complex financial decisions, it's tough. And rules are constantly changing and evolving. So if you want to stay ahead of these changes and avoid some of these tax traps, make sure you subscribe. My goal here is to give you clear, unbiased information and help protect your assets. And if you have a specific question about your situation, leave it in the comments below. So, is a Roth conversion always a terrible idea? Not always. For the right person in the right situation, typically someone with a long time horizon who's in a temporarily low tax bracket, it can be brilliant and strategic. But it's definitely not a one-size-fits-all solution. For high earners, for business owners with unpredictable income, for those who are on Medicare or may need to tap their Roth IRA sooner rather than later, it's a strategy that must be well thought out and strategically planned and executed only if it makes sense. A conversion forces you to pay a guaranteed tax today for a potential benefit decades down the road. Before you make that trade, you have to be brutally honest with yourself. Do you have the cash to pay the tax bill? Are you truly in a lower tax bracket now than you will be in retirement? Have you accounted for all the stealth taxes like IRMAA and NIT? And is your time horizon long enough to make the upfront cost worth it? Don't just listen to the gurus. Look at your own numbers, understand the tax traps, and make a decision based on reality, not on a popular rule of thumb. My name is Steve Borstein. I'm a financial planner, and you're watching the Personal Finance CEO channel.